Good afternoon, everybody. Thank you for joining us. My name is Joe Fitzgerald with Money Show, and I will be your moderator this afternoon. It's my pleasure to introduce to you Chris Belchamber on this session on how to make best investor standards empower you and transform your investment experience. Just a couple of bits of housekeeping, and I'm going to hand the floor right off to Chris. First and foremost, thank you all for participating in these events and our live events, of course, and keep those comments and feedback and suggestions coming to us here at Money Show. It makes us better. It helps us continue to refine the process, but we can't thank you enough for participating in these events. We're getting a great response to these. Secondly, there'll be a little bit of a Q&A at the end of the session, time permitting. There'll also be a Zoom afterwards that you can get with Chris directly and kind of go granular with him. But there's a live chat box on your desktop. Please just put your questions there. We'll get to as many of them as we can, time permitting. The session will last about 30 minutes. So Chris will go for about 20 or 25, and then we'll take a couple of questions, and you'll be able to get with Chris one-on-one on his personal Zoom afterwards. With that said, it's my great pleasure to introduce to you Chris Belchamber. Chris has been an investment professional since 1984. His first investment book was published by Credit Suisse First Boston in 1988. Mr. Belchamber was recruited by JP Morgan in '89 to run their UK sterling bond sales and trading, and then focused on proprietary trading, where he was promoted to managing director. Chris is also the best-selling author of a book that was just released a couple of months ago. It's getting a great response, called Invest Like the Best: The Low-Risk Road to High Returns. It's my great pleasure to introduce to you Chris Belchamber. Chris, the floor is yours, sir.
Thank you so much, Joe, and welcome to this seminar or introduction to a number of things. We're going to talk about the book, what's crucial about the book. Then we're going to get to strategy, and then we're going to talk about the markets and why the lessons really of the best investors are so crucial. Really right now we're in an extraordinary situation in the markets. So yeah, as Joe said, I've been at this for 37 years as an investment professional, and really I've always learned, developed by studying who the best people are, what they do, why they do it. And surprisingly, I find not that many people seem to do that, or at least they don't seem to model themselves that much on what the best investors do. There is a difference between what the best investors do and what everybody else does. And I think it's really important to understand what that difference is and why it's so important. So here's a cover of the book on the left. And obviously, if you follow the best investors, you're getting close to those incredible returns they get over 10, 20, 30 years. So that's an obvious reason. But the little subtext there is the low risk road to high returns. The big secret about the best investors is that these guys actually believe low risk is the way to high long-term returns, and that's not what most people get told or think, and that changes pretty much everything in terms of what you do. So anyway, let's get started. Here are a couple of passages from the book. I think they set up the tone for what we're going to do, and it's good to get on the same page right at the outset. So the wisdom and experience of the great investment practitioners addresses market reality, exposes confused thinking, and reveals a clearer and surprisingly simple structure that can be easily understood and adopted. Yes, you can do it. These guys are great, but really, it's not beyond really anybody. Investing like the best can lower your stress and risk levels while bringing you higher long-term returns. It can provide a stable platform for planning and give you more financial security now and for the rest of your life. So the first, there are two main parts to becoming a best investor, which we're going to cover really on this slide and the next slide. And about a third of the book is on each of these. So to condense it to one slide, we're taking some shortcuts, but it'll give you a flavor of what's involved. So firstly, we all have to look at our behavior. It's so important. It's something that few people talk about, but it's really, really important, and it changes what we're going to be able to achieve. There are a couple of quotes from best investors. The book is covered with quotes from people who I consider to be best investors. Let's just look at the second one here, Benjamin Graham. An investor's chief problem and his worst enemy is likely to be himself. In the end, how your investments behave is much less important than how you behave. That's wisdom from the ages from Benjamin Graham, who was Warren Buffett's teacher, mentor. And the reason why, and years later, Daniel Kahneman has gone into behavioral economics. And this chart on the right-hand side here comes straight out of Daniel Kahneman and his thinking on behavioral economics. And it really helps us become aware of how we can address that problem. Essentially, our brain has two systems. It has an emotional, reactive, reflexive, triggered part, which if you act on those triggers, you're not necessarily going to be making a very rational decision. In fact, Daniel Kahneman says that at base, we're not particularly rational most of the time. And that's a huge part. It says here 95%, but I don't know what the number is, but it is a very dominant part of how we go about decision making. And we're not always aware of what's influencing our decision. Now, of course, system 2, we do have a rational, strategic, like chess playing kind of side to our brain too, but it drains our energy. We don't spend a lot of time there naturally. And so we can use it, but that needs help. So what I talk about is to deal with our hardwiring of our brain, which doesn't necessarily mean that we're going to become a best investor. We have to start developing an investment mindset framework. And that's going to help us enormously. Once we sort out a few things, then we're going to start to be open and aware of things that we wouldn't be able to do before. So that's an awful lot in a short period of time, but we have to mention that's very important. So the other really big part of becoming a best investor is we've really got to get the investment math straight. And it's amazing how much confusion there is on this subject. And yeah, I think I've got it down to this one slide, so let's have a go at it. You can describe return. Everybody wants ultimately to have a return, but what is return? What are the components? What do you need to focus on? Is it just the return, or is it the components of return? So I've broken down return into this equation: risk times return divided by risk equals return. So that's a conceptually correct equation, sort of middle school math. Now, how you look at this equation is going to change how you invest. A lot of people are going to look at this equation, they're going to see risk on one side, return on the other, so this kind of equivalent, more risk equals more return. That's a massive simplification, and I believe it's a dangerously flawed assumption in investment management. As in our show, we'll go through why that is. Now, on the other hand, the best investors, they really focus on that left-hand side of this equation. So for them, they turn that equation into what's below here. Low risk times high return to risk equals high probability of high long-term return. And if you look at that way, you're going to make completely different choices about investing. And obviously, you're going to get very different results. And these guys are the winners, right? So that's how they think about risk and return. So we probably know that the best investors actually write about this because they have the results. So best investors have learned why they write. They have learned that risk management is essential to compounding your return. And compounding your return is where the high long-term returns come from. If you're not compounding, you're not going to get to these substantial 10, 20, 30-year high returns. So schematically, we're just going to expand on this relationship between return and risk. And if you're looking in the simplest form at return and risk, you end up with these four quadrants. You've got high return and high risk is a gamble. You could win big, you could lose big, not a clear result. Obviously, no one really wants to have a low return and high risk, so we're going to call that a void. Low risk, low return, it's probably very safe, but you need to do more than that. And where the gems are, where the crown jewels are in the top left hand, you want high return for risk. Now, what's really useful about this is that we can see that it's only the left-hand side that the best investors are interested in. And then you can plot your portfolio, let's say that's the circle here in the top left-hand corner, and you can see what your return relative to risk is. So you can track in real time, am I on track for a best investor result? So if you get your results reported to you with this performance grid, you can see where your portfolio is. You can see where all the benchmarks are. So you can see not only how you're doing, but had you just bought some benchmarks or a combination of benchmarks, how would that have done? And so every period, every time you assess what you're doing, you can look at it this way. And you can see whether you're going to be compounding or not. And you're going to be able to tell, well, should I be changing what I'm doing because there's too much risk, or we're not even meeting the benchmarks? So really in seconds, you can look at this chart and you can see precisely what's going on. So essentially it works because without capital preservation, there is no compounding. And the return to risk grid puts you on the same track as the best investors. And yes, I think we've basically said all this, so we can move on. So let's get a real-time example of why this works. And here I've taken two of the most famous portfolio managers really over the last several decades. And they have very different results and approaches to how they manage. And one was consistently successful and over 30 years spectacularly successful. The other one seemed like it was a rocket ship for 3 years and then just wiped out in a few months. If you were using the schematic we had on the previous page, you would have been able to know which track you were on and take an action before the disaster happened, or stayed with what was clearly a very successful management approach. So on the left here, we have John Meriwether, who ran the world's biggest hedge fund in the 90s. And he had several Nobel Prize winning scientists. He had a great reputation from Salomon Brothers. He raised $1.5 billion right from the get-go, and took a lot of risk. And you can see that for the first 3 years, he was like getting 100%. What you can see though, the black line is the S&P 500 and his fund is the gray line. You can see that obviously it had a lot more risk. So he was immediately in the gamble zone. So if you were an investor, you'd be saying, okay, I really need to focus on this because, you know, it's going great right now, but this isn't guaranteed because it's not clear when something goes wrong that he's going to be able to risk manage it. And in fact, in 1997, I was actually interviewed for a partnership at this hedge fund. So I actually met John Meriwether, and it was a fascinating discussion, but the energy in our conversation really left the conversation when we talked about risk. In the book, I go into great detail on long-term capital management, John Meriwether's fund, and you can see exactly what positions he had at that time in 1997, and he was off the charts on risk. And I would say that he had already gone from gamble to avoid. He was 25 times leveraged. He didn't have the liquidity to get out. It was an accident waiting to happen. If you had the performance grid, you would have known that you need to look, you would have studied it, and you'd have found out you needed to get out. So that's why it's such a useful tool. Then you get Jim Simons. He is the system software designer. So in terms of behavior, he'd already gone completely into System 2 brain. And he was brilliant. He started the quant movement in the early 80s. And you can see over 30 years, the black bars, they're all in positive territory. Every single year, he made money with one small exception at the beginning, where I think he lost maybe 5%. But otherwise, you can see consistent risk management always in place. The S&P 500 had some down years. His fund did not. And at the end of 30 years, you had 30% compounded return. If you were looking at the performance grid on this one, you would have been on the left-hand side, low risk, and you'd have been in the top left-hand side because the alpha was tremendous. So that's how you can use the thinking of the best investors to know which track you're on. And this is a great example. So the bottom line is return, if all you're doing is looking at return, it really doesn't tell you much at all. Particularly for just a few years, you don't know really what's going on. The return to risk grid showed you which track you're on. So it's vitally important that you look at the return to risk grid at the minimum. So the problem that a lot of people have with this idea that we take less risk, are you really going to be able to make more return? Can I believe that? I mean, because I've been told that high risk equals high return. So I'm not sure about this. So here's a great example of why that is true. What is very useful if we look at the billionaire positions, and we got 20 billionaires portfolios that we looked at over 20 years, or Tradesmith looked at over 20 years. And you can see what they did. And the gray line here at the bottom is the S&P 500, and the black line is the 20 portfolios of the billionaires. They have to report their positions. We know what they bought and sold, when they did it. And overall, they beat the S&P 500. So, you know, that's perhaps not a surprise. They're pretty good with money. So how can we do even better than the billionaires? So what we did is we applied the pure quant model It sounds kind of complicated and jazzy, but really all it does is it takes 8 steps, all of which lower the risk of the portfolio. It buys the same securities on the same days that the billionaires buy. So we're just replicating, we're not making any judgments about the securities at all or the timing. We're just doing a different money management technique, which in every case lowers risk. So the whole system is laid out in the book. You can see every step. And the blue line is what you get by lowering risk significantly. And you can see from the blue line compared to the black line, in the rising market, it outperformed. Then it massively outperformed over 2008, 2009, because it simply got out of the market. And then when the rally started, it got back in. So it was outperforming in a rising market and in a falling market by taking lower risk and compounding relentlessly over the 2 decades that we looked at. Now, of course, once you find that you have something that really works, then you can start thinking, well, we could do it slightly better. And just by choosing which 4 billionaires, because not all the billionaires was good at investing as some of them are, you can get another result as well by doing that. And you can see that going from the S&P 500 150, you get to 300% with the billionaires, you get to 520 with all 20 portfolios with pure quant applying to them. And then you get almost, well, you get 1400. So it's amazing what you can do. So pure quant is just the beginning of this low risk, high return way of investing that the billionaires, the best investors have been doing for decades. And I just want to say that this is just the beginning of applying a low risk methodology and getting higher returns. There are all kinds of systems. I've listed them on the left there that you can use. And we were just looking at equities. I mean, obviously many other asset classes too. So when you start thinking about how you can do this with more models, with more asset classes, you suddenly have a whole range of ways that you can improve, become more efficient in how you're allocating money. And this is really what the best investors do. So imagine the possibilities for further optimization of your portfolio towards best investor performance. So let's talk about the markets and how where they are and how we should be thinking about it. It's really quite extraordinary what's been going on now. I think the key point is this left-hand chart here. The biggest 4 central banks have had an explosion in liquidity. They bought $10 trillion worth of assets in the last year or so. You can see that enormous explosion. If you take out $10 trillion worth of investable assets from the markets, it makes a difference. You create a shortage, the markets like that, and they go up. And so relentless as this been is that investors become really comfortable with the price action. It just always goes up. It's become a behavioral certainty in the minds of many. And you can see that in the right-hand side, that just this year, in the first half, we had 600 billion of US equity flows into the market. And that is as much as we've had in the last 20 years combined. So everybody is getting into this market at a rate that we've never seen before. And what's true of the equity flows is true of speculators, margin debt, everything. These are extraordinary and extreme conditions, but I think we shouldn't forget that at the root of this is an extraordinary behavior by the central banks. What it's done is it's moved asset prices into extreme distorted levels. Stocks and bonds are really kind of off the chart now. This was taken before the latest inflation numbers we got yesterday, but you can see that on the left-hand side, 10-year bond yields are 1.5%. Normally, with the core CPI being where it is, it would be 6.5%. That's 80% below where you might think Treasury bonds should trade. That's a massive distortion. On the right-hand side, we have the S&P 500, and this is the price to sales ratio compared to the subsequent 10-year performance. Obviously, the higher the price to sales, the lower your return is going to be normally. And you can see that right now we are right at the extremes of price to sales. We've never been here ever before. And it actually indicates that in a normal relationships, your expected return would be -5% a year for the next 10 years.
Chris, you have about 5 minutes, sir. Okay.
Okay, great.
Take your time. Thank you.
Thank you. Here you've got a fund manager in Boston. They're saying that too. Normally you make a 6% real return over a 7-year period. Every class of stocks and bonds is negative except for one, but we're all well below the 6% normal level. So the next decade will challenge every investor. Are you ready with the best strategies you could have? Are you using best investor techniques? Are you lowering risk and getting alpha? Best investors have a wide array of techniques across all asset classes. The gap between the best investors and everyone else is about to widen. Are you prepared? I hope I've been able to show you that best investor metrics make your capital safer. Your long-term compound return can improve. Probability of long-term returns is high. You're going to make better investment strategy choices with the performance grid. Real-time assessment can help you. You'll choose better financial partners. Your financial risk and volatility will increase your ability to plan. You've got some stability and some prosperous stability. Lower volatility and higher return will lower your stress levels and increase confidence in your long-term future. I'm committed to this, and I can help you get there. What I'm offering is for people who schedule a free consultation, you get a free copy of the book. I can do your best investor ranking with a quiz. We can look at your risk return outlook of your portfolio. You get those expected returns, see what it looks like. We can do your best investor reallocation. We can apply pure quant to your portfolio. I'm offering 20% off financial planning, and you can learn about the Invest Like the Best masterclass. I'm going to be doing a Q&A after this, immediately following this presentation. I'm sorry I've run out of time. I had a lot to say. And you'll be able to click the Zoom link in my virtual expo booth. So thank you for your time and attention. And if we've got a chance of any questions, then please fire away.
Chris, thank you very, very much for your insights. We had a good crowd in the room for you today. Unfortunately, we don't have time for Q&A right now, but as Chris mentioned, right after this session ends, you can refresh your browser or just go back into Chris's booth. There'll be a little Zoom link in his booth, and he'll be free to talk to you over the next 30, 45 minutes. And if you can't do that, please get with Chris, because obviously he mentioned he is managing money. He's been doing it a long time. Personally, just a personal note, I have read the book. I've been in the financial service business for a long time. It is a phenomenal book. It's a great tool for your investment process. Again, I don't have an axe to grind. I know Chris, but the book is great. It was referred to me earlier this year by a friend of mine. So Chris, really well done. We appreciate you coming and joining us here at Money Show. Folks, get with Chris afterwards if you have questions. And we want to thank everybody who participates in these virtual events. Obviously, Chris and all the other people who are in these virtual events the next 3 days. And of course, the people that attend. They're coming for tools. They're coming to be empowered and educated. And it's sessions like these that, keep people coming back. So if you have questions, comments, feedback for us here at Money Show, send them in. We want to hear them good, better, and different because it makes us better and it refines our process. But again, Chris, thank you, sir, for your time. And we want to wish everybody a great afternoon. Enjoy the rest of the Virtual Expo today and, of course, all day tomorrow. Thanks again, folks. Take care. Thank you, Chris.
Thank you.